Welcome to the Legacy Radio Network. This is the Everything Financial Radio Show. I am your host, Dennis Tubbergen, and I am here every week at this time. Hope you and yours are having a terrific long Christmas holiday weekend. Hope you have family around and you have a great time. You know, we have a terrific show for you today. Mr. Ian Gordon of the Long Wave Group will be stopping by. I thought it would be especially appropriate to have him on the program in light of the recent announcement by the Federal Reserve that printing $40 billion a month in new money is not enough. They're going to add $45 billion to that. The Fed is now going to be printing $85 billion in new money every month. That's over $1 trillion a year. Mr. Gordon is one of the best economic and fiscal historians that I have met or had the pleasure to interview. And we're going to talk with Mr. Gordon about what's happened in the past when policymakers and politicians have opted for this particular policy response, and what can you do to protect yourself. You know, a lot of folks don't know this, but in today's program also I'll be talking about the fact that the United States in its history has already had one currency failure, and the characteristics of the currency that failed are a lot like the characteristics of the current U.S. dollar. So certainly we'll talk about that. You'll want to stay tuned for that. Even though the election is just behind us, it seems that pork spending has resumed in Washington. I'll give you an update. We'll also be talking about what's going on in Europe. A psychotherapist wrote a report after spending some time in Greece, and what he's observed in Greece are nothing more than really, really ugly consequences and symptoms of a deflationary depression. And we'll be talking about what's going on with central banks printing money, because it seems the Federal Reserve is taking the lead and all the other central bankers around the world are following. So we have a lot to talk about on today's program. I would remind you that if you would like to go listen to any of our interviews that we do here on the program, you can go to everythingfinancialradio.com. That's everythingfinancialradio.com. Just click on the Listen to Past Shows link, and you can choose whichever interviews you'd like to listen to. Also, you can go to the iTunes store. Just search Everything Financial Radio, and you can get a podcast of any of the programs that you have not had a chance to listen to. So again, iTunes store, they're free. Just search under everythingfinancialradio.com. Also, we're preparing a all-new group of discovery groups, an all-new series of discovery groups for next year. In 2013, you can look for announcements at personallegacyseminars.com. That is personallegacyseminars.com to see the dates and topics. Those will be posted very soon. I am pleased to have back with me on the Everything Financial Radio Show today Mr. Ian Gordon. Ian is president and founder of the Long Wave Group. It's always a pleasure to have him on and get his perspective and insights. And Ian, welcome back.
Well, thank you for having me again.
Ian, you recently wrote a piece about how, in your view, the stock market was close to a peak. Given that the Fed seems to be continuing to print money, which drives up potentially equity prices, according to Chairman Bernanke. How have you reached that conclusion?
Well, I'm a big believer that all markets are governed by natural law anyway, and that the interference, on the part of people to try and continue to keep equity prices at high levels ultimately is doomed to failure. But, again, from the perspective that I have, which is the long wave perspective, and knowing that we are in the winter of the long wave, which is the season when debt is wrung out of the economy, so that but by the spring the economy can start refresh with little or no debt overhang in it. And the stock market, the bear market in the winter season is always akin to the previous bull market that occurred in the autumn of the cycle, so that, you can go back, it doesn't matter which autumn you go back into in the cycle, and we've had 4 autumns, we're in our 4th cycle, we're in the winter of the 4th cycle right now, but even if you go back to the previous autumn cycle, that was the Roaring Twenties, 1921 to 29, and that was akin to the bull market of 1982 to 2000. So effectively, from a long-way perspective, the market peaked in 2000. The Dow reached 11,750 on the 14th of January 2000, and from then it went down into October 2002. Interest rates, the federal funds rate was at about 6% in 2000, and Alan Greenspan, the then Federal Reserve Chairman, brought interest rates down to 1% by October 2002, and that was enough to effectively reignite the stock market, and we got a recovery in the stock market. But more importantly, what that did was not only was he bringing interest rates down to very low levels, but also flooding banks with money, and that, of course, led to the huge speculation in real estate and the huge run-up in real estate prices and the real estate bubble, which effectively peaked in 2006. The stock market, again, recovered and recovered into October 2007 when the Dow hit 14,200. And again, from that peak, it crashed into 2009, and the Federal Reserve Chairman Ben Bernanke brought interest rates down from, again, around about 6% in 2007 all the way down to effectively zero, trying to reignite the economy and get the stock market going again, which he was successful in so doing. So that and now with the stock market having risen from March 2009 into the sort of 13,200 level where we are today, the Dow where we are today, he hasn't been following this increase in stock prices by bringing up interest rates as has occurred on the two previous occasions. So that when this stock market peaks, and I'm pretty sure that we are close to a peak, and in fact I do believe it will peak in 2012 rather than 2013, and I have a reason for saying that, and I'll tell you why in a minute. When this stock market peaks, he doesn't have the ammunition of bringing down interest rates because they're already at zero, so that the only cause that he may have is to continue to flood banks with money, which he's doing right at the present time anyway. But the reason I picked 2012 as a stock market peak, because I'm a big believer in Gann numbers. W.D. Gann was a great trader and a great cycles trader, and he effectively used the 100-year cycle or the 20-year cycle or any derivative of 20 years and so on, and said that you often got major sort of changes and shifts in those kind of anniversaries. So we have a lot of anniversaries occurring in the year 2012. For instance, the big bull market that started, the big autumn bull market started in 1982. So 2012 we have an anniversary back to 1982. The first bear market bottom was in 2002, so we have an anniversary here in 2012, the 10-year anniversary of that first bottom in 2002. The peak in 2007, we've got a 5-year anniversary from that peak, which is, a derivative of the 20-year cycle. So my feeling is that we're very close to a peak here. Once we go back into the bear market, the ammunition that the Fed had in bringing down interest rates isn't available to them anymore, so that that's the end. And when this bear market resumes, it's going to be pretty bad. And we've always had a target for the Dow of 1,000. We're sticking to that target of 1,000 on the Dow. We're not going to say that it's going to happen by next year, but eventually this bear market is going to be very, very vicious.
Ian, on the program not long ago, we had Robert Prechter, and I'm sure you're familiar with his work. He actually concurs with your downside target of 1,000, and he, for a number of reasons he laid out on the program, said that if he were to speculate, he would have the bottom somewhere around 2016. Can you give me your thoughts on that timing?
Well, I think that's probably good timing, and that would be, 4 years from now. Nothing goes down in a straight line. I mean, once the bear market resumes, it's going to be the the first leg down, I think, is going to be pretty vicious, and it's going to take us below the level that we were in early March 2009. So, the Dow's going to probably get to somewhere below 6,000 in this first leg down, and then we're going to get a recovery. Something's going to force that recovery, and we're going to sort of recover somewhat in stock prices, and then we're going to get another leg down, and that's going to take us below that first leg down. So if you look at the 29.32 crash, when the Dow lost 90% of its value, there were actually 8 legs down in that crash. So there were recoveries and then down, and recoveries and then down. So I think 2016 probably makes a lot of sense, because we've got a long way to go down.
We are chatting with Mr. Ian Gordon of the Long Wave Group, and in the next segment, we're going to do a segment that I'll just dub Monetary History with Ian Gordon. We're going to pick his brain and see that we've really been here before, and what's happened in the past, and will it tell us maybe where we're headed from a monetary perspective. So stay tuned for the next segment. We'll be chatting again with Mr. Ian Gordon when we return. Stay with us.